the speculators don't see quite the same bullish storyline to sustain the upside move.
Hi again, everybody. Welcome back to the Comstock channel. I'm Marlin Bohling with you. I am joined today by Joel Camp. He is with Comstock Investments, and we're going to take a look at our market action here in the middle of the week on a Wednesday. Kind of a mixed bag, I guess, if you look at the grain sector here. Joe, a lot of weakness on the wheat trade for one thing. Kansas City wheat, which had been outperforming all the others, it seemed like they took a lot of that back today.
Weather is the word for wheat, and we have some slight improvement in the outlook, including current conditions with some minor snowfall reports in parts of the plains. More major snowfall, we should mention, in parts of the central plains. I saw posted online, Nebraska facing another winter storm. It feels like spring in other places, so a lot of attention there. We recently had some of those individual state crop condition reports come out. Deterioration again for Kansas wheat, steady for Texas, but still lower on a year ago for a lot of those hard red winter growing regions. And, a risk point for sure when we think about the motivation for why Kansas City in particular has led the way higher here recently with some weather premium entering in the mix. It was just a change of pace, though, here with this latest round of showers in places moving through, and again, snow in other areas. We'll take it as kind of the mentality for the most part. I've got, sun shining through my office window. It feels like spring to start the week, but we know spring also brings the threat of more severe thunderstorms. We've got tornado watches in the middle part of the country again. And we're, thinking more and more about weather as we approach this new spring season. Of course, spring already officially tomorrow.
Kansas City May wheat, the trading range today straddled the 200-day moving average. It looks like it's closing just a little bit below that. On the other hand, if you look at the Chicago wheat market, Chicago wheat has had difficulty even getting up to the 200-day moving average. It's not even really very close to it yet. So is that very meaningful or not?
So far, we're seeing that some of those meaningful moving averages also coincide with certain even money marks. Like for Chicago wheat, it's been a real point of resistance, getting and holding above $6. For Kansas City, we've been above that level here with recent strength, but on today's give back, a settlement back below $6 for what you mentioned, that May Kansas City. So that we also have the 200-day in play, maybe a further correction lower to test the 20-day, sort of the middle of the range, near 585 for that contract. The technicals absolutely come into play along with those weather fundamentals that we mentioned. They're going to continue to be the deciding point for whether or not the commodity trading funds are going to resume their short covering effort that they've largely been underway in on the wheat market. Because unlike corn and soybeans, where we had this period, corn a lot longer, soybeans just briefly, but also recently turning net long for the hedge fund position, you don't have that on the wheat, having still been in net short side of things for a long time. This could be a continuation of a shift. Those speculators, when we talk about weather, they also know that the seasonals are ahead in terms of bullish potential for not only the grain market, corn and soybeans, which could help pull wheat higher as we head into the planting season, but for wheat as well. When you approach the winter crop harvest season, it's oftentimes in early May that prices can be led higher before that harvest really ramps up. So things we're watching technically, seasonally, weather-wise, those are all important factors for the speculators and what they choose to do now going forward with wheat.
I want to get your take on what you see when you look at the corn and the soybean charts. Let's talk about the nearby contracts here on the May. It depends on how you look at it. Some would say that we are in a congestion period on both the nearby corn and soybeans. Some would say that we're forming a wedge pattern, and that could mean a breakout one way or the other. We just don't know which way. I'm curious to see how you interpret the charts there on the corn and beans right now.
Right now, we're having a small corrective rally in what is ultimately still a primarily bearish trend. We know that we're coming down from 2022 highs and that we're still largely stuck in that bear trend, despite this bounce that we had after last harvest, the late August lows for corn coming up from 360 on the continuous chart to just over 518. We fell a long ways, gave back over 2/3 of that total rally for corn, and have since just largely built up that little wedge or congestion zone that we could very well break out of. Would we get some more bullish news or start to see the speculative buying resume on the back of those seasonal tendencies that we just mentioned? But for now, it's something to be skeptical of. I look at a nearby chart and see that the May corn is back just above its 20-day moving average, so that's a good thing. But when you see an uninspired type of trade that we've been in these last couple of sessions, you know it's still very much wait and see mode, and wait for the next news item to break in particular to shake up the chart and give us direction. And unfortunately, we've just been more negative on all of these headlines, and the risk of tariffs or you name it seems to, for now, lean more technically bearish. But again, the hope or the silver lining for the bulls would be that we're now starting spring tomorrow again, and that usually brings about at least some injection of weather risk premium leading into the planting season.
Do you think it's unusual for corn and soybeans to move very much ahead of the prospective plantings report that always comes out on the last day of March?
Normally, we would see them, having locked in the ideas relative to coming into the February outlook forum, which we've already put behind us. Those numbers largely confirmed our expectations, and seeing the heavier corn and the lighter soybean acreage to 94 and 84 million acres. There can and has been still some relative weakness on the soy side, with some ideas being that these lower prices after February, we bring up the February crop insurance averages being up slightly for corn, but down about $1 for soybeans. That's only going to reinforce these decisions come these next couple of months. And so we could see a further price adjustment, but likely after we have that next dose of data coming at the end of the month.
You know, you and I have both been at some meetings recently where I think we were a little surprised at the amount of old crop corn that had already been marketed by the farmers in the audience out there. Now, in a way, I guess I was glad to see that, because they took advantage of earlier rally prices. On the other hand, what do you do with the grain that's left right now? Are you willing to be more patient with that this year?
For the grain that's left, when you look at the timing that we're in, you have to circle back to that seasonal that I mentioned, and now feel like the old crop marketing opportunities are going to be tied to the new crop strength, that potential leading us higher. Now, the other more old crop focus that we shouldn't overlook would be coming up on that same day, March 31st, in this case, with the prospective plantings report that gets top billing, but also the fact that it comes with a quarterly stocks update. That can be a point at which we're all of a sudden saying, oh, wait, we really have been using this corn. And you look at now real solid support for calling the USDA too low on ethanol usage and exports. And that can really change matters and give us this little push, again, post March 31st crop report, if it can be a friendly one for usually both, but or acres or the grain stocks look. And so that can be our chance. Otherwise, leading into, we mentioned it's early May for the wheat market to get these old crop sales wrapped up, and some new potentially priced for corn and soybeans. It's historically June that we've topped out on average the last 5, 15, 30-year timeframes. Last year it was May, so we need to be prepared to potentially take advantage of strength if we see that a bit earlier than would be seasonally suggested. But that's the idea, is that if you've got old crop left to catch up, on, then you're going to have some attachment to what's ahead now with this transition of focus towards the new crop. And that's the other part of it, the idea of farmers being so well sold compared to a year ago, definitely, but compared to most years as well. The silver lining can be that there's less left to sell against what could be rising prices if the speculator returns as a buyer. If the speculator returns as a big bull because of weather or because of whatever factors that clear the way for them to return in this market, then there's going to be less resistance in this case from farmers having to dump a bunch of what's left. Like last year, that was an absolute hurdle or a headwind for the market that we had at this point. So much left of the old crop. And so when prices did have these little pokes higher, like including into the seasonally higher swing into spring, it was met by a lot of catch-up selling. And so that can be an opportunity as well, as if we get that little push higher by speculative interest into the spring, that'll be our chance.
Well, we already know that we have a record crop of soybeans coming out of Brazil and South America as a whole. On the other hand, we look like we may have some weather issues with the safrinha corn crop that's just kind of getting established in a lot of areas, still being planted in some areas, but they're kind of wrapping up on that. If that's the case, do you see the stage being set for corn to maybe gain on soybeans over the next month?
That's the trend in the news related to Brazil, exactly what you bring up about these threats on safrinha corn. The other thing I'll bring up is the tightness of the old crop supply, including now what's freshly harvested of the first crop, which is now the smaller crop in Brazil. It's going to be used up domestically, we would expect, as opposed to that safrinha, which we normally expect to compete with on U.S. corn exports down the road. Before then, though, it's worth mentioning, not only are there these outlook worries for the safrinha crop being planted now, but there's this thought about how tight the old crop supply is in Brazil, in part an ongoing conversation about the discrepancies among the USDA numbers and, well, basically the rest of the world. Not only CONAB in the past couple of years, but even you could bring up the USDA attaché office in Brazil, Brazilian private analysts from across the world calling these last couple of crops a lot smaller than what the USDA has on the balance sheet. And, let's just let the market do the talking. We can see that there's these pushes higher for premiums on this old crop corn in Brazil. It's something that's recently allowed for a good premium over the U.S. market as well. So that can be a source of strength going forward for corn. And as you allude to, it's relatively not as a bullish of an issue for soybeans that we have this record crop now harvested and filling the pipeline, plus not to mention the dynamics with, as we know, our top customer of soybeans, China, flipping their interest amid this tariff fight down into the southern hemisphere in an even bigger way. So safrinha corn, these dry weather issues, worth watching.
Well, let's take a look at the livestock side here on the nearby live cattle, the April contract. My goodness, we're within roughly $50 of new contract highs again. Feeder cattle, no problem there. I mean, they just continue to post new contract highs as we go. Now what do we do? I mean, now that especially if live cattle reach that all-time high level that was set, it's been, what's that been, maybe a month and a half ago or so? What do we do? I mean, what happens one way or the other if we take it out or if we don't?
On the top side, there's really not anything you can say, right, at all-time highs in terms of, can we go back to test this level from 2014 in the case of cattle, those last big highs? No, we're in uncharted territory. You can maybe start to draw some extension levels, but the idea would be we're out to new highs, and like the feeders, we can keep going, especially if we should bring up those commodity trading funds. they continue to be such a dominant force in this market. If you look at the speculative net longs, well, they're really close to it, or now there this week at a record net long, a new one for live cattle futures. The last report included another new record net long for feeders. You're talking about positions that are like 25, 30% plus of open interest in the entire market. Recently, as strong as the corn net long was, for example, the commodity trading funds held up to about a 15% portion of total open interest. So you get back to the cattle futures and what we think of as a relatively thinner market in terms of total volume and open interest. And when the speculators are still pushing the gas pedal from the long side here, it's no doubt a bullish factor. But will they tire and be ready to take profits at some point? We're looking at technical indications for that suggestion. Lately, maybe some bearish divergence in the fact that, we're right up here at all-time highs for the feeders. We're at new all-time highs today. But are the momentum studies keeping up? Something I'll look out for. Right now, no, not necessarily. We don't have a new high to speak of on some of these charts for just the basic relative strength index or the moving average convergent divergence or the basic stochastics that you look at. We're right up there, and they can continue to push. You get a big volume day up, but we look at these numbers and we wonder if it is close to being exhausted, this big run-up rally. Normally, we'd think that would occur before what we've observed lately, though, and that's getting back to the fundamentals. There is absolutely your core supply and demand support being provided for this market in a still very thinly supplied supply side type influence that we know has been bullish for so long. And then lately, just the idea that demand hasn't collapsed and hasn't really faltered. It's weathered this storm in the outside financial markets and the lower stock market really well. And all those things have brought us to where we are.
On the other hand, what about the hog market? Do you see much happening there or not?
Well, there was all of a sudden some big volatility to speak of. We started off the week with a big rally, but then have since given it all back. I think it's similar to the cattle in that these speculators are holding a pretty aggressive net long in the market, but they're far enough removed from that now that there's questions of if they can push it back towards new contract highs, which would still be, in the hogs case, a lot still short of the all-time highs. So we're not at that same juncture as the cattle. And the speculators don't see quite the same bullish storyline to sustain the upside move for hogs right now, at least, because like we've talked about with tariffs, we can come up with a lot of ways that tariffs are friendly for price potential on cattle, curbing the flow, namely of feeder and finished cattle imports from Canada and Mexico, and maybe even blocking off supplies of beef from a country like Brazil. But on the hogs, it's more about, well, you think about our top customers, and they're all the ones being targeted or subject to being targeted now in early April for new tariffs. And we think that the retaliatory tariffs from countries like not only Canada and Mexico, but China, definitely a big pork importer still, not like they once were, but the top 5 or 6 right now. And then on to Japan, a really big deal when you bring them into the mix and think about what could be ahead with these reciprocal / retaliatory tariffs against U.S. pork exports, which are, as a share of pork production, much more considerable, for example, than beef is to cattle. So right now, not the same bullishness from all sides like cattle, but also too, not a total turnaround into a huge bear market for hogs, and they're holding up so far this week better than maybe can be expected.
Yeah, it just seems like the lean hog market is happy and content to just chop around sideways in between the 100 and 200-day moving averages, and it just seems to have found a comfortable spot right there. Joe, it's great to visit with you. Thank you for the insight into Wednesday's market. Always a treat. I appreciate that. Joe Camp of Comstock Investments. That'll do it for this episode. And we thank you for joining us. For producer Brianne Jenkins, I'm Marlin Bohling, and we will catch you next time right here on the Comstock channel. Futures trading involves risk. The risk of loss in trading futures and or options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.